A handshake right now between the U.S. President Donald Trump and Israel Prime Minister Benjamin Netanyahu at the White House, where the President of the United States has unveiled what he is calling a 20-point plan to end the war in Gaza. Prime Minister Netanyahu saying that he has agreed to that 20-point plan. Of course, the one bugaboo in all of this is we still don't yet know whether Hamas and the other leaders for the Palestinian territories will agree as well. Romaine Bostick alongside Katie Greifeld. This is The Close. We are kicking you off to the closing bells with the focus today on geopolitics and what could potentially maybe be an historic agreement in the Middle East. Joe Matthew joins us right now. He's the co-host of Bloomberg's Balance of Power. And Joe, I know you had a chance to listen to what the president and the prime minister had to say. I know you had a chance to go through the outline of this 20-point plan. As the president said before he stepped off the stage there's a lot that still needs to be discussed and a lot of signatures that are still needed to make this go through. Where do we go from here?
Well, that's right. I mean, I don't want to be skeptical, but we need to be sober about this, Romaine. The fact of the matter is this president has something in common with former President Joe Biden. They have both rolled out multi-point ceasefire and longer-term peace plans that have not gone anywhere beyond the initial announcement. Now, of course, having Benjamin Netanyahu by President Trump's side is significant, but this is a proposal, not a deal. They have not heard back from Hamas, whether it's a yes or a no. Hamas has acknowledged that it's received this proposal, but they spoke openly, both of them, about what would happen if Hamas did not accept this proposal. The president saying that the U.S. will back Israel with whatever it needs to do to finish the job in that case. But, Romaine, we cover a lot of these in Washington. I have never seen two world leaders step into the state dining room or the east dining room, or the east room, I should say, for that matter, for a formal bilateral news conference and decide openly not to take a single question from the scores of reporters who were in that room and waited hours to see them. The same thing took place in Alaska, however, the last time President Trump stood alongside Vladimir Putin.
Yeah, Joe, and I am curious, too. I mean, we should point out, we talk about this idea of what Netanyahu said, that in his view, that there cannot necessarily be a Gaza territory that is ruled by Hamas or the Palestinian Authority, which I would assume could potentially be a sticking point in whatever negotiations. And I guess my question for you, Joe, is who is actually negotiating on behalf of the people in Gaza?
Well, that's a great question. Knowing, of course, that Israel tried to strike the most recent round of talks in Qatar, the president himself said this is a very different Hamas than existed at the beginning of this conflict. There are largely different people here in control, and whether they're talking with Steve Witkoff or the Qataris, it's going to be a very different prospect when they sit down with this 20-point plan that, by the way, dropped just moments before these two went on stage today, suggesting that they were finalizing this behind closed doors. I will also add that Benjamin Netanyahu, via social media, putting forth an apology to Qatar, pledging not to strike its sovereign territory again.
All right. Well, certainly a developing story. Really appreciate the latest. That is Balance of Power co-host Joe Matthew. Now, let's kick things off to the closing bell here. Of course, we're keeping an eye on U.S. markets, and let's keep that conversation going with David Bianco. He is Chief Investment Officer for the Americas over at DWS Group, joining us on set. Great to see you, David.
Katie.
So in not taking questions, one of the reasons that President Trump cited was the fact that they have a meeting coming up with the Democrats later today as we head into what seems to be an all but assured government shutdown this week. And just focusing on the domestic here, should we actually see the government shut down? Should we see those BLS numbers delayed on Friday? What does this mean for U.S. stock market hovering close to all-time highs?
So much going on in Washington, D.C. and the world, and following that important press conference, it reminds you there's a lot more going on than just the stock market and artificial intelligence. It's possible there's a shutdown. Chances are much higher than it's been in a long time. I don't think this administration is afraid of shutting the government down. They might use the opportunity to take some more decisive actions, including job count reductions, if that occurs. So I think the Democrats are actually going into this with a weak hand, and if they're willing to push some of the... So a shutdown's possible. I don't think the equity market reacts negatively to it, but there's a lot of unfinished business in this market, whether it be where are these tariffs going? Will there be refunds or deferred tax assets related to that? What's going on with these key conflicts that have gone on for too long in the world? So yes, corporate profits have been strong, but at this stage, it's going to be difficult to surprise investors to the upside. And I think this market's a bit tired of all the rallying and all of the...
But to that point, can you just surprise them to the downside? And I mean, I'm not talking about the big black swan, gray swan, but I mean, it seems like all year long we've been climbing this wall of worry over tariffs and the Middle East and Ukraine and, you know, you name it. We've been climbing it, and it's record high after record high.
Climbing the wall worry, and sometimes when you're looking down from high above on a green pasture, and that's what we've been doing, maybe that actually stalls the rally. I do think this equity market, because of valuations, because of the slowdown in the economy, because of the uncertainty around what the Fed does next, and the deficit and the tariffs and a world in conflict, I think it'd be very healthy just to see that, you know, retail investors as well as professional investors are paying attention and making sure the market doesn't get too far ahead of itself. A 5–10% pullback in October, in November, and then maybe we finish the year where we are here. That would make some sense just to me to see that we're paying attention to the risks and making sure there's some good upside for the full year and years to come.
Well, let's talk about where you can pick and choose your spots in a market that could pull back 5 to 10% in the coming months. I look through your notes, I see that you identify small caps as an opportunity. That seems like one of those long-term theses that just struggle to play out.
Right, and we have not been pounding the table on small caps. We've been one of those who've been pointing out to the idea that, one, it makes sense to diversify from the highly concentrated S&P 500. Get something other than tech, no matter how much you like it. And we've looked to foreign equities and small caps, but with small caps, we point out that it's important to do it with professional investment. Don't do it yourself. Get an active strategy. And if you're doing it yourself, then maybe look for more profitable indices like the S&P 600 rather than the Russell 2000. The overall Russell 2000 is at 31 times this year's earnings, a 30% premium to the S&P. Only if you exclude the 30% of the index that's unprofitable do you get about a 30% discount. So pick them carefully and probably lean a little bit more toward the financials within small caps.
All right, David, great to get some time with you. Appreciate you stopping by. That is David Bianco. He is Chief Investment Officer for the Americas over at DWS Group. Meanwhile, let's keep that conversation on the shutdown going, because Washington and Wall Street both in a holding pattern as that possible shutdown looms. President Donald Trump set to meet with Democrats ahead of tomorrow's deadline at 3 p.m. Eastern in the hopes of swerving a potentially weeks-long halt in operations. Our next guest says that a shutdown is likely but wouldn't last long. Let's bring him in now. His name is Mark Zandi. He is chief economist over at Moody's Analytics. Great to have you with us, Mark. For context, the longest shutdown was about 5 weeks. But even if this one is brief, even if it's just a week long, what would that mean for the U.S. economy?
Well, Kay, there's no upside to this. It's only downside. But if it's a week, really no big deal. I think shutdowns have become kind of operating procedure here in Washington, and I don't think it would surprise anybody. A couple weeks, maybe that shaves about 0.1% off of GDP in the quarter, and that's probably a pretty good rule of thumb. For every week the government is shut down, it shaves about 1/10 off from GDP growth. If it lasts 4 or 5 weeks, now you're getting to where we were under President Trump, one the longest in history. Then we start to see some damage because government services will get disrupted. If it lasts much longer than that, then this becomes a big deal. But the most likely scenario by orders of magnitude is this lasts a week or two, and it's just one more shutdown in a long list of shutdowns.
Yeah, and it's interesting. I mean, when you go back in history, I mean, we've seen these shutdowns. I actually was in D.C. Back in the old days when we would have these shutdowns, and the economic impact was relatively minimal and relatively contained. There is some concern this time around, Mark, that we're not just talking about temporary furloughs. You have a president that's basically threatened to permanently fire at least non-essential federal workers should the shutdown occur. On top of that, I do wonder about the timing of the shutdown coming right at the start of the fiscal year and whether that changes the dynamics of what the impact could be.
Okay, Romaine. I mean, if the scenario is that the unnecessary workers, unessential workers are actually fired, they're not furloughed, which has been the case in every shutdown, but they are actually fired. We're talking, 650, 750,000 people potentially impacted by that. that's serious, right? That's a 0.5% on unemployment, and that's just by itself. You fire that many people, then there's going to be all kinds of disruptions in government services, everything from NOAA to TSA to FDA, SEC, you name it, it's going to be disrupted. That's the fodder for an economic recession, particularly in the context of the current environment when the economy is already struggling with tariffs and immigration policy, DOGE cuts, and everything else. So, I really don't think that anyone's going to go down that path of firing workers. But if we did, that's a whole different scenario.
Well, speaking of layoffs, speaking about this labor market, you think about what we're supposed to get at 8:30 a.m. on Friday, those jobs report numbers. And of course, the NFP report has taken on added importance, added urgency as we try to chart where the Federal Reserve is going to go. So just thinking about the sequence of events here, to have the BLS numbers delayed potentially on Friday, this is already a murky labor market, and this certainly wouldn't make things easier.
Yeah, no, the timing isn't great on that, is it? We've got a Fed meeting coming up here, and I think the Federal Reserve would really like those numbers and trying to make a decision about interest rates. But again, if it's delayed a week, the release of the BLS number, or even 2 weeks, I think that's okay. But you're right, much longer than that. Then in addition to all the other chaos that will be created, just not getting the economic data will be an increasing problem. And you make a wonderful point. The point in time when this is happening is particularly inopportune because the economy, the job market is kind of right on the edge here. A little bit of job growth, a little bit of job decline. Which way it swings here in terms of more or less job growth or outright declines is going to be really critical to try to understand where the economy goes and, to policy, what the Fed should be doing here. So, hopefully this thing lasts only a couple of weeks and is no more than a couple of weeks and we get that data. If we don't, obviously, I think just makes it much more difficult for the Fed to operate when it's already a very difficult time for them to operate.
And just real quickly, Mark, only about 30 seconds left. I am curious just about what is the state of the economy, in your view, right now, independent of the shutdown?
It's struggling. I think the GDP numbers last week put on a brighter hue on the data, but it's still not bright. We're growing below potential. And the key thing to remain is the job market is stuck in the mud. And, if that goes south and we see some job losses, then, recession risks will rise very quickly.
Mark Zandi, chief economist over at Moody's Analytics, as we keep an eye on Washington, where leaders from both the Democratic and Republican parties are at the White House meeting with President Trump about that budget impasse. It could set us up for a government shutdown this Wednesday. We do want to turn back to equity markets and take a look at, well, probably the most talked about stock of the day. It's been halted off and on. It is Electronic Arts. Earlier today, we did get confirmation here of Electronic Arts being taken private. A little bit earlier, Wedbush cut its rating on the stock to neutral and trimmed the price target in anticipation of that deal. Joining us right now to talk a little bit more about this is Alicia Reese. Joining us right now. Alicia, great to have you here on the program.
Thanks for having me.
Thank you. Senior Vice President of Equity Research at Wedbush Securities. And Alicia, I think a lot of us were taken by surprise, not so much by the fact that this is happening, but maybe by the price tag being attached to it. And I am curious as to how you were valuing EA prior to this deal and whether $50 billion seems appropriate.
Yeah, well, I had a $210 price target on it. I shouldn't have taken it down, as it turns out. Our valuation was in anticipation of a really strong launch for Battlefield, and the future anticipation of their ability to take that to a battle royale function. Now, with all of that, we didn't have all of that in our numbers, but the potential for the upside from that all going really well, which I think was priced into shares and in large part, but not all the way, reflected the real possibility of where that could go. That was probably the peak at 210, but we probably should have kept it there. Hour and a half after we published that note, they announced the deal at 210.
But that's what a lot of people are saying now, and I guess if it's taken private, this all ends up becoming moot. But still, the idea that this is a valuation that a lot of people see not so much just as a peak for the company, but the idea that as to whether we should be viewing this more as an exit strategy for some of the executives.
Well, they did say that the CEO will stay on to run the company, and I think he will for a period of time at least. But I think the more interesting point is that the PIF fund has the ability and the assets to really leverage one piece of EA, which is its mobile business, and remove a paywall and create more free-to-play options for their games, and really get that to significantly more profitability. Which, if done right, done well, that could pay for the transaction altogether. So I do think there's a lot of growth potential within EA that this consortium can really pull out.
Let's talk about that a little bit more, because you think about some of the issues that EA is dealing with, as well as the industry when it comes to sales and layoffs and studio closures. What levers can they pull in private with this consortium that they wouldn't necessarily be able to do as a public company?
Yeah, I mean, just the basics of not having to report their numbers and the unit sales for each of their titles on a quarterly basis, and having to talk about them and reach lofty investor expectations, take their time with some really good properties, and then create more value in between with more free-to-play options. There's so many different possibilities that they could do with that and really leverage what they've built with Battlefield. In addition to that, they can take all of the licenses, renegotiate them, and just do more with that. And the deep pockets of the PIF really gives them the ability to do that.
Would you anticipate that there could be any regulatory hurdles that could maybe bedevil some of this?
Well, there's not really much in way of competition, because the PIF doesn't really have that much in terms of the video game industry. They're building it, but they don't have a lot that's in direct competition with what EA does. They do have properties that will help leverage what they're doing, but it's not like what we saw with Microsoft and Activision. On the other hand, it is a sovereign wealth fund, so there could be CFIUS involvement. Just looking at the data situation, U.S. data, and trying to protect that. And so there could be some, regulatory issues around that and protecting that data. But ultimately, I think they can get around that very easily. And I don't think that Saudi Arabia in general is against any sort of restructuring to protect that. That's not what they're after.
Hey, Alicia, real quick, we only have about 30 seconds. Do you see any other potential peers in the space potentially being in play in terms of acquisition?
Yeah, everyone's up for acquisition. I think in this space, you have some big money managers or big companies that have much deeper pockets with which to run a video game company, and it's really expensive to make video games, especially to make them that are extremely compelling and have a variety of different entry points for different types of players. And so, yeah, there's certainly a lot up for play.
All right, Alicia, great to get some time with you on the heels of this confirmation. That is Alicia Reese. She is Senior Vice President of Equity Research over at Wedbush Securities. And coming up, Strategy Executive Chairman Michael Saylor joins us to discuss his outlook for the Bitcoin Treasury Company. That conversation next. This is The Close on Bloomberg.
3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. We're keeping an eye on this equity market, but we're also keeping an eye on gold, having yet another good day. And the headline came this morning that you take a look at the U.S. gold reserves, Romaine. They actually hit $1 trillion in value as gold just continues to hit all-time highs.
Yeah, the U.S. sitting on something like 261 million ounces worth of gold. But there's an interesting twist in this, too, which I kind of forgot about, that kind of based on some weird laws that we have, we actually peg the value of our gold at a price that was set by Congress. Get this, Katie, all the way back in 1973, before we were born. $42.22 an ounce. Don't laugh. $42.20 an ounce. And of course, it's a lot higher than that today. So this actually has a potential to become a mark-to-market event. Basically, the Fed will basically have to issue the certificates, which would effectively put money into the coffers of the Treasury, believe it or not.
And some folks have been calling for that. I don't know if anyone is listening, but you see numbers like this and you think about that mark-to-market potential here, and certainly it gets some ideas spinning.
Yeah. And they want to replace this with Bitcoin?
Well, I don't know about that. But let's talk about Bitcoin, because gold, it's outpacing Bitcoin so far this year, with, as we discussed, the U.S. Treasury's gold reserves reaching a staggering $1 trillion during that record run. But of course, that hasn't stopped Strategy, the world's largest corporate holder of Bitcoin, from going full steam ahead into derivatives products such as Bitcoin-backed digital credit instruments, including the first Treasury-preferred Bitcoin-backed stock. And joining us now, I'm pleased to say we have Strategy Executive Chairman Michael Saylor. Michael, great to have you with us. This is Bloomberg Television, so we're going to go into all of the financing strategies. But let's talk a little bit first about MicroStrategy's premium to its underlying Bitcoin holdings, the MNAV, if you will. So it's interesting, if you take a look at the past few months, MicroStrategy or strategy shares have actually been underperforming Bitcoin. That has taken your premium down to about 1.4 times. And I would love to hear your perspective on why that dynamic exists. Is it something about the market? Is it the fact that you have all these digital asset treasury companies coming to the fore, or is it something else?
You know, the market's still working to digest a new business model. The Bitcoin treasury company is an idea that's only come to the forefront in the past year or so. For 300 years or so, the world revolved around gold-backed credit instruments. People issued bonds and credit based on gold. We've discovered the killer app in the Bitcoin world is Bitcoin-backed credit. I'll call it digital credit. You know, in the 20th century, we had bank credit, we had mortgage credit, we've got commercial corporate credit, you've got sovereign credit. Well, digital credit is a new creature, and Bitcoin treasury companies exist to issue digital credit. So the reason there's a premium in the equity is because we can create digital credit instruments. If we were just an ETF, we wouldn't be able to create credit instruments. The credit itself is an extraordinary new asset class.
Well, when we talk about the premium, and it's been at lower levels, but you think about the premium coming down, I think it was closer to 2 a couple of months ago. Is that something that concerns you as you look at these different types of financing vehicles that you have?
No, I'm not really concerned. What happens is the premium will expand as our leverage increases and as the volatility in Bitcoin increases. When the volatility falls and our leverage falls, sometimes the premium contracts. But the real key here is the digital credit we're issuing, like Stretch. That represents us stripping away the volatility and the risk from a commodity, from Bitcoin, the digital capital instrument, and then distilling out a particular currency, USD, a particular yield, say 10% on Stretch, and then a certain duration for that yield. And we offer those to the credit market. So we don't really need a premium to issue digital credit. Our business model works fine whether or not the equity trades at a premium or a discount to the underlying Bitcoin. The equity will have value because people understand the value of the credit instruments. And we've launched 4 credit instruments this year, $4 billion product lines, and the year's not even over yet. So that's a lot for the world to digest since they didn't see a new class of credit for 100 years before us.
Are you concerned at all, Michael, though, about some of the newer entrants into this space and whether that maybe not necessarily usurps what you're doing, but I guess augments it in a way that your next fundraising and your next efforts might not get the same attention and buy-in as you did in the past?
No, I see it as a positive thing. There's been an explosion of Bitcoin treasury companies and digital asset treasury companies in general. I think we were the first. There's 250 now. There are tens of billions of dollars of capital flowing into the space. We're the first company to show that we could create a treasury preferred stock like Stretch. We were the first ones to issue any kind of Bitcoin-backed credit like Stride or Strife or Strike. We're going to be differentiated based upon the quality of the credit instruments we bring to the market, the degree of collateralization, the degree of liquidity, and of course the risk. And because we're the largest player in the space, we can offer the most liquidity, the most collateral, the strongest brand, and the deepest markets in those instruments.
How do you respond to some of the concerns out there, if not just direct criticism, about the potential sales of any of your holdings and what that could do to the market?
We're so way over collateralized, it's hardly a concern. I think we've got $74 billion of Bitcoin. We've got $6 billion of these preferred credit instruments outstanding right now. They don't even come due. I think it takes 1 or 2% of our annual equity issuance to cover our dividends. So not a big concern.
Not a big concern. It's interesting. I mean, you think about the position that you hold when it comes to Bitcoin, which is basically never sell. You hold forever. And then I was listening to a conversation this morning with Tim Draper on BTV with Matt Miller, who was saying that Bitcoin is the currency of the future. You're going to have a day where you have U.S. retailers using Bitcoin instead of U.S. currency. And it falls into basically the store of value versus currency debate. And I wonder, Michael, whether those two viewpoints can coexist together, or is it going to be one or the other?
No, I think that the digital asset economy is exploding, and the winning digital currency is the tokenized dollar in the form of Tether and Circle. And that entire asset class has exploded to about $250 billion. I mean, so if people want a circulating medium of exchange on crypto rails, they're using stable coins in the form of tokenized dollars. Bitcoin has emerged as digital capital. What you want is a commodity that's also scarce and decentralized as a long-term capital asset. So the killer application of Bitcoin is digital credit issued against digital capital, whereas the killer application for medium of exchange is a digital currency in the form of a stable coin. I think the crypto industry understands this, and I think the people of the world understand it. If you talk to anybody and ask them how they're going to pay for their cup of coffee, they're going to send a stable coin from their mobile phone app. And if you ask them, what do you give to your granddaughter, they're going to say, give them a Bitcoin.
There you go. Michael, before we let you go, we talked about some of the different types of financing that you have when it comes to preferreds, when it comes to convertible debt, and of course, when it comes to common stock. Are you considering any new type of debt, or are you happy with the categories that you have right now?
Well, if we look at these preferreds, first of all, they're leveraged, but they're not debt because the principal never comes due. Stretch, I think, represents kerosene. It's like extracting jet fuel from a barrel of crude oil. And so we're very excited about that. And we think that there's an opportunity to create stretch-type instruments in euros or yen or Canadian currency or pounds. In essence, everybody in the world would love to have a high-yield bank account that yielded 10% or more, or they'd love to have a money market that gave them double or triple their normal money market. We have shown that you can extract that sort of instrument from raw Bitcoin if you have enough Bitcoin. So I think that we will continue to grow the AUM of Stretch, and then we'll look at opportunities to transform it into different currencies around the world.
All right, Michael, really appreciate it. Michael Saylor there, Executive Chairman over at Strategy. We should point out Bitcoin, after 2 straight weeks of declines, getting its mojo back over the last couple of sessions. MicroStrategy right now on its strongest 2-day run going back to the beginning of July. Meanwhile, another stock that we're keeping our eyes on is Carnival. The share is hitting some choppy waters after reporting underwhelming guidance. It's our stock of the hour. That discussion's next, right here on The Close on Bloomberg. All right, let's take a look at shares of Carnival. It's our stock of the hour, hitting some stormy seas. The company reporting results for the most recent quarter, though it did raise its full-year earnings forecast for the 3rd straight time. Nevertheless, you see the pullback in the shares on the day. Nora Melinda joins us right now, who covers stocks for us here at Bloomberg. Why is the stock down if they're raising the forecast?
Everything's looking pretty for the most part when you actually dig into the earnings. But if you dig a little bit deeper, this is Stifel saying that essentially the street was nitpicking, quote unquote, here. There's actually a little bit of pressure that you are seeing as it relates to their net yields guidance for the 4th quarter of this year. So that did come in lower than expected. But overall, you are having a lot of Wall Street analysts still positive on the stock. I mean, if you look more broadly, 74% of Wall Street has a buy rating on this company, and only none have a sell. So, I mean, the majority are still saying to buy. A lot of them coming in with their notes today, underscoring the fact that this is an opportunity to buy here on weakness.
Yeah, well, with that in mind, perhaps we will see this dip get bought Carnival shares, currently off about 4%. You take a look at some of the other cruise lines. They are lower on the day, not as much, but this nitpicking, this skepticism being applied to Carnival, does this mean anything for some of their peers in the space?
I mean, to your point, you are seeing a lot of the other peers starting to take a breather. They are coming off declining just a touch here. But I mean, you have Malloy Research also saying that this is an opportunity to continue to buy here, especially the fact that apparently cruise lines are taking share from traditional land vacations. And I didn't know that. I didn't know this many people were going on cruises here.
Yeah.
But apparently that's the case. And they seem to see that as
I've heard this a lot. And we've had some of the executives on from Carnival and Norwegian, a few others. They've talked a lot about this idea that, like, when you stack it up against flying to a certain place, booking a hotel room, and doing all the other stuff, that sometimes just getting on a cruise ship might be a better value proposition. We should point out, this is still a stock that was up, like, 80% off those April lows.
Right.
So, I mean, it's been on a phenomenal run. So a 4% pullback may look like a lot today, but in the broader context, no.
Absolutely. I mean, year to date, up about 18% here when you look at Carnival. So, I mean, it is an interesting dynamic right now, especially with all the macro going on.
Yeah.
But to your point, maybe people want an all-in-one. They want to have their food, they want to have their adventure, the activities everywhere on a boat.
On a boat.
On a boat.
Why not?
Yeah.
Through the seas.
Yeah, I've never actually been on a cruise.
Yeah, no, I'm not a boat gal.
I've been on one of the, like, party boats that, goes down like the Hudson River.
That's fun.
I did not enjoy that.
As long as
So I'm not sure, several days on a
Nothing
cruise
abroad.
Yeah, I want to keep my eyes on land. Nora, great reporting. That is Bloomberg's Nora Melinda. And coming up, we'll take you to the closing bell with Daniel Newman. He is the CEO over at Futurum. This is The Close on Bloomberg.
There's three phases to AI and most technology cycles. The first phase is the sexy phase, the consumerization of a new technology. The second phase will be the applications of it. And then the third phase is the data infrastructure part of it. So not everyone's going to survive, but I'm very bullish on companies like Databricks, Snowflake. No matter what AI does, it's always built on data, and you need the right data to take advantage of AI.
Robert Herjavec of Shark Tank fame there. I had a chance to catch up with him last week while you were on vacation, Katie. You missed a great conversation. I mean, obviously we talked about entrepreneurship.
Right.
I asked him about all the inside baseball on Shark Tank. But he had a lot of thoughts about AI and just kind of technology, investing, how much has changed. Of course, he obviously made a fortune in the cybersecurity space, and he sees that as being a big component of this going forward.
Yeah, absolutely. That was a conversation I was sad to miss. All the other ones,
All the other
too.
ones you were fine missing.
It's interesting, though, to hear all the different avenues into AI. We've been so focused on the Magnificent Seven. We've been so focused on the picks and shovels. But obviously, when you're trying to catch the second wave, you're probably looking beyond that.
Well, I tell you, the folks over at Futurum, they've been digging deeper into this, like a lot of folks, trying to figure out where the next big trade is going to be in AI. Daniel Newman is the CEO over at Futurum, and they're releasing a list of the earliest non-Mag 7 disruptors. It includes names like Broadcom, TSMC, and Palantir. Pleased to say that Dan joins us right now as we count you down to the closing bells. All right, some of the names on this list I'm not surprised at all. I do want to start off with the number one on the list, and that is Broadcom. And I have to admit, this is maybe my own ignorance, but up until maybe, I don't know, about 3 or 4 months ago, I hadn't really paid much attention to Broadcom as an AI play. Explain why that ends up at the top of your list, Dan.
Yeah, first of all, Romaine, great to be with you and Katie. Thanks for the time. This is our first rebalancing. We actually put the first list out about a quarter ago, and today we announced, or just last night, we put out this rebalance. And Broadcom, which actually was number 2 last time, got the upgrade to number 1. And the long story short here is that this company has executed just incredibly well in 2 areas. One is this custom AI chip space, which there's a lot of debate around whether custom AI chips or whether NVIDIA just went to OpenAI and they basically solved that OpenAI doesn't need one anymore. But we believe they do. And we actually have forecasted this custom AI market to grow faster than the GPU market starting around 2027. And Broadcom has about 70%, we estimate of that market. So we think they are incredibly robust in these custom chips, but they're also a critical component provider for the networking, which is, as you heard Robert Herjavec talk about all that data, well, we have to also move all that data, and very little data moves without Broadcom. So they move the data, and now they're providing compute to so many companies, including Google, likely OpenAI, and a number of others.
And a lot of people, I think, have finally sort of woken up to the power or the potential of Broadcom. There's one name, though, that was towards the bottom of your list, of your top 15 list here, that has also sort of reawakened, and that is MongoDB. And I think it was after their earnings in late August, where a lot of people looked at what they had to say and realized that there was something there. And I think the stock has been on a tear over the last, 5-6 weeks, up 40-50% or so. What gives you interest in that name?
Yeah, I heard that interview before. We talked about names like Snowflake and Databricks, both names that are very interesting to us. Snowflake's on our list as well, but the data is what makes AI work. So we've heard a lot lately about energy. That was a big trend in this one. A number of companies moved up on that trend line. We had Oracle really high in our original, and they were one of the big winners in our first quarter because of data. Well, Mongo is another way that companies are getting that operating data and making it available to their applications. And basically, the two things are symbiotic. And Romain, I'll add one more thing about that is basically there was a number of people that had sort of left SaaS or these software as a service companies for dead. I was one that was critical, and I do think a number of these companies are in trouble. We actually downgraded a number of companies that were in that area. But these companies like MongoDB that provide a service that enables data and applications to work together, this is going to be critical for us to move on from this infrastructure build out that we're talking about all the time to actually starting to do more with AI, especially in the enterprise, because so much of it now is just those consumer use cases.
And Dan, what's interesting to me taking a look at this list is that it covers a lot of different sectors here. You have chips represented, you also have some cloud names, you have cybersecurity names as well. As you were putting it together, I mean, what were some of the different buckets that you were thinking of?
Yeah, I'm glad you asked that. First of all, we were asked so frequently, go beyond the Mag 7. It was like everybody felt that NVIDIA had been played out, although I don't agree. There's still some real upside there. Same with names like Google and Microsoft. But where are the opportunities in AI? So in the first wave, we really were looking at a lot more of these applications. So you saw names like ServiceNow, Salesforce, Oracle that have applications. And what we found over the quarter was a lot of that stuff sort of faded. People doubted that technology. We don't doubt it longer term, but when we're looking at how we design the AI 15, we are looking for that alpha. What are the companies that we think in the shorter term? So we're looking at the semiconductor companies. We're looking at the companies that have big moats. So you'll see ASML and TSMC. There are no companies right now that really compete with those two. We're also looking at things like cybersecurity. And just before this, Katie, I heard the trend line about cyber being really important. We agree with this. As AI proliferates, security is going to be so critical. And we think more investment needs to be made there.
So we're talking about the AI 15, this list of non-Mag 7 disruptors with structural positions here, Dan. Is this a zero-sum game? Are there a list of 15 companies that are going to suffer the most from AI?
I don't think I think that's a good question, actually. There are some companies that are going to be massively disrupted by AI. We're already seeing it. You heard me mention earlier in the software as a service space, if you're using ChatGPT or these Anthropic tools and you're already asking it to say, hey, generate me a table, generate me a report, generate me a project plan, you can already see how a number of applications, I remember Satya Nadella coming on and talking about deprecated CRUD databases with logic. Well, there's a lot of applications now that being able to go out and generate something in real time is going to be disrupted. So that's where these companies having all of that important data is going to be a differentiator. So we love the applications that are in the data space, the Databricks, the Snowflakes, the MongoDBs. You can see them represented here. Yeah. But we're still optimistic. There's companies like IBM on our honorable mention list. Yeah. Doing enterprise AI is really hard. And so it still has to be executed. And I think a lot of people are taking that for granted.
Absolutely. And I'm glad you brought up IBM. And of course, Oracle, you could throw in that bucket. There's a big part of the reason why we've seen them get so much business. It is that experience, decades in the making. Dan, great to have you. Dan Newman, the CEO of the Futurum Group, talking about their AI 15. And we should point out, while it's not a barn burner of a day on the markets, right now, the Mag 7 and tech stocks are higher.
Yeah, the S&P 500 up about 0.2%. We're looking at a fifth straight month of gains, up about 3%, unless something crazy happens.
I thought this was supposed to be the worst month ever in the history of months.
Seasonal's not your friend this year.
Well, it is this year, apparently. All right, we're going to break down all of today's market action when we come back with our global simulcast that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld, taking you through to the Closing Bell with a global simulcast. Carol Massar and Tim Stenovic join us from the radio booth. Welcome to all of our audiences across all of our Bloomberg platforms, including Carol Massar, our partnership with YouTube.
Yeah, exactly. Across all of our platforms, we've certainly seen markets bounce around, definitely off their lows of the session as we head into a close. Kind of a quiet market, but I do feel like, Katie, got a lot of things coming at investors, a potential government shutdown. We also had some big news in terms of the war in Gaza, and we're also awaiting a jobs report on Friday, if indeed we don't get that government shutdown, which, of course, that could prevent the data from coming out.
Right, that's the big if, whether or not we actually do head into what a lot of folks are saying looks more certain than not that we are going to see this government shutdown as both sides dig in.
Do you think it happens, Katie?
All right, so we keep an eye and we talk about sort of where this market is going, guys. And I just want to just kind of point out, we talk about the idea that seasonally this was supposed to be a month where, if not certainly a down month, certainly one that was going to be a little bit more muted. You look at the gains we're sitting on and you look at what sort of led us to those heights and the multiple record highs that we've had so far this year and, of course, this month alone. And the big question right now is whether that continues for the rest of the year. Interesting note out this morning by the strategist over at Goldman Sachs talking about the ability for a year-end rally, and positioning in this market seems to suggest the same. We talked about it last week, the idea that everyone is selling puts, the idea that people are protecting more against potential upside melt up rather than any sort of downside, the idea that an accommodative Fed, potentially accommodative fiscal policy, and an earnings season up ahead that a lot of people have high expectations for, that could keep the rally going. Green across the screen here on this Monday afternoon with the Dow Jones Industrial Average up about 0.1% or 70 points. The S&P higher by about 18 points or 0.25%. NASDAQ Composite up about 0.5 percentage point, as is the NASDAQ 100. The Russell 2000, that is your relative laggard, but it is going to close in the green, only up by about a point. But I think given all of the concerns out there, Carol Massar, coming into this week, I think a lot of people will take it.
Yeah, it's really kind of fascinating to see the continued churn higher. I mean, earlier in the session, you kind of had an even split between winners and losers. But Katie, here at the close, 308 names in the S&P 500 gaining ground on this Monday, 195 to the downside.
Yeah, pretty good breadth for what are pretty contained moves on the benchmark level. Same story when you take a look at the sectors. The circle is very green today. Consumer discretionary and tech leading those gains. If you're looking for something to nitpick, you're going to find it in communication services, off by about 0.5%, and you're going to find it in energy, off by nearly 2%. But as you can see by how small that slice of red is, that has very little bearing on the overall benchmark.
All right, guys, let's get to some individual gainers. I had to talk about AppLovin because this one at its highs today, up about 11%, finishing the day with a gain of about 6 1/3 percentage points, 6.3%. It's a top gainer in both the S&P 500 and the NASDAQ 100, I believe hitting an all-time high today. It's a mobile app marketing company, and analysts have been weighing in on this one in a big way, raising their price targets, creating new street highs, one after another. I mean, on Friday, Piper Sandler raised its price target to $740 from $500. On Friday, also UBS raising its targets to a street high view of $810 from $540. Stock closing at $712 and change. Today, Morgan Stanley raised the target on it to $750 from $480. A little catch up there, maintaining its overweight rating. Basically, what analysts are saying, they're talking about momentum in gaming, staggering profit margins, phenomenal growth. That stock has more than doubled this year. All right, got to talk to cannabis stocks. Investors pretty high. See what I did there?
Oh.
I know. It's so lame. Tilray Brands, ticker TLRY, up about 61% here at the close. So pretty much finishing the day at its highs of the session. President Trump posted a video on social media yesterday that touts medical benefits of hemp-derived CBD for seniors. So we saw some excitement in that name. And I just wanted to put out Electronic Arts. I mean, this one about to be public no more. Stock was up about 4.5%. This after agreeing to sell to a group of private investors in a deal that values the company at about $55 billion, marking the largest leveraged buyout on record. I think there was about $20 billion in debt that's going to be part of that deal, and that's after about a 15% jump in the stock.
Can I just
on
add an
Friday.
honorable mention? The big move we saw in
I would
Etsy
expect
today,
no less
up about
from you.
16%, Carol Master. I know you're a big shopper. That's the best day going back to 2022. But all this idea of integrating ChatGPT and the chatbots into the platform here, both Etsy and Shopify getting nice bids on the day.
Don't tell my husband, though. I thought you were my friend.
All right. I want to go with some of the stocks that were lower today. Hard to find them, but I got three for you. Carnival Corporation, the parent company of Carnival Cruise Lines, among many other brands, the largest cruise operator in the world. For much of the day, it was the worst performing stock, down 4% on the day. It was the worst in the S&P 500, even though the company came out with record revenue, adjusted earnings per share for the third quarter that beat the average analyst estimate, and they raised their full-year earnings forecast for the third straight quarter. They said there's a record pace for forward bookings and improving net yields. For next year, they've already got half of what they have offered booked up already. That's for the year of 2026. We did speak to the company's president and CEO just moments ago. He said the trajectory is good, the consumer is strong, he's extremely optimistic, and he's seeing strength from everywhere in the United States right now. Still, shares finished down 4% today. Williams-Sonoma shares fell 4.7%. This was actually the biggest decliner in the S&P 500. It's the owner of West Elm, Pottery Barn, and more. President Trump out saying that he would levy new tariffs to boost the domestic film and furniture industries through a pair of sweeping plans. He did post today that he would be, quote, imposing substantial tariffs on any country that does not make its furniture in the United States. It is unclear exactly how that would work because companies, not countries, manufacture furniture, and the duties are charged on specific imports, not governments. The White House did not respond to a request for further details. Shares of Williams-Sonoma down 4.7%.
You have that cloud couch, right? About $8,000 or something.
I don't even know what that is.
No, I don't. I sit on the floor. I'm still using my futon.
Futon guy. It's ever since college, right?
Yeah, I mean, honestly, best $200 I ever spent.
Okay. Beyond Meat. Shares just cratered today, down 36%, lowest on record. The company made an offer to debt holders that would erase more than $800 million of debt. The offer allows debt holders to replace convertible notes with new bonds and shares of common stock, with 47% of holders already agreeing to the exchange. Romain?
I just want to put an honorable mention on there. You saw the drop in Open Door. I know you're a big fan of that, Tim Stenovic.
Meme.
And, of course, those shares are down for a second straight day. A lot of criticism right now about what Eric Jackson has been doing. Of course, that vigil outside of Drake's house in Toronto, and now other investors basically saying that, look, be careful. All right, we do want to turn back to some breaking news, and this involves the budget impasse going on in Washington. We are learning now that Republican and Democratic lawmakers are now currently meeting with President Trump at the White House to hopefully try to create some sort of deal to avert a government shutdown, which would take place at the end of tomorrow, Tuesday, the end of September 30th. I do want to check in on yields because, believe it or not, I mean, that was actually a big focus for a lot of the market moves that we saw today, particularly when it came to the rise that we saw in gold, particularly when it came to the drop that we saw in the dollar. And we did see a bid come into treasuries. That actually pushed yields down across the curves. Modest drops, to be sure, 1 basis point on the short end of the curve and 3 to 4 basis points on the longer end of the curve. But obviously, this is going to be way in focus, particularly if we get to tomorrow night without a deal, particularly with that big jobs report hanging over us this Friday.
All right, speaking of reports, we do have some earnings starting to come out ahead of the official start of earnings. Vail Resorts out, and we are seeing this stock down a little bit in the aftermarket, down maybe about 2%. Let's get to the outlook. Sees 2026 total reported EBITDA of $844 million to $906 million. It also talks about the fourth quarter, the quarter that was. Fourth quarter loss per share of $5.08. That's a little bit steeper than what the street was expecting for. They were looking for a loss of $4.73 a share. Fourth quarter net revenue, $271.3 million. That too is just a tad light. The estimate on the street was $274.4 million. And they also talked about fourth quarter total skier visits at 753,000, excuse me. The estimate on the street was 772,916. So you can see the stock, like I said, down already this year, about 20% year to date, taking another hit to the downside, guys, down about 3.5% here.
Yeah, more bad news for Vail. Light across most measures, as you mentioned, Carol. And you think about what a rough year it's been for Vail in 2025. That ski patrol strike all the way back from January, certainly some bad PR there. They actually brought back their old CEO. So a boomerang there, incurring some costs there. You add it all together, and another rough quarter for Vail.
Yeah, Rob Katz taking over for Kristen Lynch a little earlier this year. Surprised, I think, a lot of people that he actually came back. I'm looking at the press release, and buried in the press release is some information that investors might not love. Past product sales through September 19th, 2025. Remember, they have the Epic Pass. The idea is you buy it early, so revenue for the year is not as bumpy, but it gives a good idea of who's going to actually be visiting those mountains and that portfolio of mountains for the remainder of the year and into next year. Those sales decreased approximately 3% in units, though increased approximately 1% in sales dollars as compared to the prior year period through September 20th. So even though they're more expensive, if fewer people are going, that means less spent on-mountain dining, less spent on rentals, less spent on lessons and more.
But this gets to this idea, and I mean, we know that this is kind of a business, at least certainly in the modern age, that caters to a higher income consumer. But we've talked before about some of the issues we were seeing in Vegas with regards to a different type of leisure travel, and the idea that some of this is kind of a cell phone. You know, it was kind of like this hubris of continuing to raise prices and milk more things out of your customer. For a while, they were onto it, but it now seems you're starting to see some cracks in that model. You're certainly seeing it in the casino space, and maybe you're starting to see it skiing as well.
Well, it's like falling off a cliff right now.
You don't want to do that when you're skiing.
Sorry, that was pretty
stay
sad.
On the trail.
All right, but shares of Vail Resorts, they're down about 2.7% here in the aftermarket.
I almost fell off a cliff once, but thankfully they had that little, that wooden fencing thing.
Yeah.
But I got
Were you on the
tangled up
bunny
in it.
trail? What do they call them?
No, Romaine's like
on the triple diamond.
Hey,
Oh,
on Fridays in the winter. On Fridays in the winter, I'm like, Romaine, what are you doing this weekend? He's always going skiing.
Wow, I'm impressed.
Can't keep up.
Remember our old colleague Eric Schatzker? I don't know what happened to him. Did we fire him or something?
No.
But he literally goes on these trips where he has to take a helicopter up to the top.
Yeah,
and then
because
they
he's
just jump out
Canadian.
of
He's
the top of the
serious.
helicopter.
He's
and I remember he
serious.
showed me a video, and I was like, dude, I'm never going skiing. with
Built
you.
different.
All right, well, shares of Vail,
love
they're
Eric.
down about 3.5%. We're awaiting Jeffries, expected to report too after the close. So that's a wrap. Our
Did
cross-platform.
Carol get rid of Eric Schatzker?
No, he's
I would
working
never.
from home.
I love Eric. Oh my God! Stop it! Stop creating rumors. All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Romaine continuing there on the close. Tim and I continuing on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
And our coverage continues here on Bloomberg Television. We are learning that congressional leaders are meeting with the president right now to discuss that budget impasse in Washington. When we come back after the break, a conversation with Kim Wallace over at 22V Research about the looming shutdown in D.C. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. Welcome back. It's been a week.
I'm thrilled to be here. It's been a long week.
Yeah, it's been a long week. You missed a lot last week, but we should point out the price action today is kind of reflective of the price action that we saw in a lot of days last week, incremental at best. Sometimes it was to the downside, but today it's to the upside, at least for the major indices, the Dow, the NASDAQ, as well as what's the other one? The S&P 500. There you go, Katie Greifeld.
The important ones.
The important ones are all up here on the day, fractionally to be sure. You did get a bit of a pullback and some flatness in the small and mid-cap space. Keep an eye on the dollar. We saw some weakness there, and we saw a big boost in gold. Some concern right now about what's happening out of Washington.
Absolutely, which we will get to. But let's take a look at some of the individual stories underneath the hood of that S&P 500. I have some good news and some bad news. The good news is Robinhood soaring by more than 12%. The CEO coming out and saying they're making inroads on prediction markets. A different story for Williams-Sonoma. Of course, we heard from the president this morning threatening furniture tariffs. Williams-Sonoma shares down about 4.7%. Nvidia too higher. No real news here, but of course that 2% pop helped lift the S&P 500 just a little bit. And that brings us to our top story, that rally in stocks losing steam slightly as you have these concerns rising about that looming government shutdown. Trump's meeting with top congressional leaders currently underway, Romaine, as the U.S. nears its first shutdown in nearly 7 years. And we know the clock is ticking.
All right, let's go right to Capitol Hill right now, where our congressional reporter Eric Watson is standing by. And Eric, I mean, what do we know right now about the divide in terms of what the Democrats want and what the Republicans have on the table?
You know, my expectations for this meeting are very low. I could always be surprised in Washington, but, you know, Republicans are really eager to sort of blame Democrats for this shutdown. The White House Budget Office has said they'll do mass firings. Probably they were underway anyhow, but now they can sort of try to pin the blame on Democrats. Democrats, meanwhile, really want to break through with their message on rising health care costs, try to get some kind of deal on expiring Obamacare tax premiums, you know, which will basically see the middle class see huge spikes in their monthly payments. So the incentives are not there for a quick deal. You know, there is some chatter up here on Capitol Hill about a 10-day potential stopgap bill. I talked to a high-level Republican aide just before coming on here, and he shot down that idea. So I think this meeting, you know, may turn out to be more fireworks than substance. And as far as I'm concerned, we're headed to a shutdown. Crucially for stock in the markets, the shutdown would lead the BLS, the Bureau of Labor Statistics, to be completely shut down and not issue a crucial job report on Friday. So we'd be kind of be flying blind as far as economic statistics.
Absolutely. The fact that we could see those jobs figures delayed certainly adding urgency here. But Eric, as you said, it seems like a lot of the signs are pointing to we're going to see a shutdown. And given some of the issues that you mentioned, the divide that we see between the Republicans and the Democrats, can we read anything into how long this could potentially last?
You know, one thing I've been looking at is in the mid-October, you're going to see military pay from the and federal worker pay from October 10th to October 15th. They really start to feel a lot of pressure, you know, when the troops, you know, our essential workers, as our Homeland Security and others, continue to work without pay and start to have to worry about juggling their finances. So I would, you know, in the past we've had these October shutdowns in 2013. They only seem to last the middle of the month. I would see a lot of pressure, going beyond that. But there's also members of the moderate, Democratic caucus who are very nervous. And when you ask them, people like Jeanne Shaheen, one of the forefront of trying to get these Obamacare premiums extended, if you try to, pin her down on will she really shut down the government, she's a bit, squirming under the spotlight there. So I think, the real question is, can Schumer hold it together? All it takes is 8 Democrats to peel off from this coalition and sort of say, let's reopen the government. I think it would be a short shutdown, but and something far shorter than the 35-day shutdown under the Trump administration 1.0.
All right, really appreciate your reporting. That is Bloomberg's Eric Wasson. Let's keep this conversation going now with Kim Wallace, head of Washington policy research over at 22V Research. Great to have you with us, Kim. So my understanding, even though you hear a lot of consensus building around the fact that we could see a shutdown that seems more likely than not, listening to those voices, seems like you're still in the camp that we could avert this. So give us the other side.
Well, the other side is, how do you explain the shutdown? And then, as Eric was saying, what gets you back to reopening the government? Democrats will have to ask themselves the question, if their health care message is better played while government is shut, and that's the story number 1, 2, and 3 in all of media, or if they debate in committee and on the floor, give speeches pointing to what they think are the shortcomings in healthcare policy of this administration. For Republicans, I understand the Senate dynamic and the need for 60 votes, and you need 8 Democrats to get to that 60-vote threshold. But the perception coming into this town for the past 8 months is that unitary government, along with a very compliant, some would say, Supreme Court, has Republicans running things. So to be able to blame all of this on one party or the other, I think they're each speaking to themselves. I would note this, Katie. Every time we've come to this shutdown that I can remember the last time in 30 years, there's been a lot of noise on each side about why shutdown made sense. I'm not hearing that from either side.
Well, Kim,
I doubt we shut down.
Let's build on that a little bit. You lay out both sides nicely, but when you think about it through the lens of public perception, who potentially has more to lose here if we do head into that shutdown, whether it be the Democratic Party or the Republicans?
History shows 2 things. 1, you don't know with certainty. And 2, when the public decides who the instigator was, they punish that party. 2013 is a good example. 1995, 1996 are good examples. Another of the reasons I think it'll be really difficult to convince both parties to go into shutdown is none of them know how to manage it and have high confidence in their ability to market persuasively for their side while government is shut down. Economic populism is raging throughout the globe. It is absolutely in display in Washington and throughout our country. Healthcare is one of the top issues in household economics. It's silly to imagine that closing the government, precluding constituents from easy access to their benefits in healthcare, and doing that while you try to convince them you're on their side, you're fighting for them so that healthcare can be better in the future. It's very difficult to even come out with a sentence to try to have that make sense. I don't think they're going to shut down.
I am curious, though, about the optics. I mean, if the Democrats, for that matter, give in to what's on the table by Republicans and they don't get concessions on health care and some of the other things they've asked for, Kim, what do they actually carry into 2026 with regards to a midterm election? I mean, it's one thing to say, hey, we avoided a shutdown, we're on your side. It's another thing to have to go explain to those people why you didn't actually deliver on some of those things that you said you were going to deliver on.
Well, Romaine, another option for them is to take the 7-week CR through November 21st and talk about health care in Washington and in every district and state of the country between now and the 21st. The Affordable Care Act tax benefit doesn't expire for another 3 months. You have 3 months to make this the issue if you want to. When it comes to rescissions, whether they're pocket rescissions or rescissions signed into law, the first step for Democrats' negotiation is with Republican colleagues. You can't skip that and then go directly to the president. I think Democrats might be able to put together a stronger hand on health care in particular. Later in the quarter.
I am curious, though. I am curious, though, in your opinion, Kim, who leads that charge? Because, I mean, at this meeting right now, it's Schumer, who's been relatively quiet over the last few months, Hakeem Jeffries, who's been a little bit more vocal, but a lot of people don't necessarily look to them as being sort of the arbiters, if you will, of what the party is, and more importantly, what voters want.
Romaine, you hit a nail on the head. It's one of the reasons I don't think Democrats are going to invite a shutdown. Neither Democratic leader Jeffries or Schumer has done, in the eyes of most people, a bang-up public job of explaining why shutdown is the best option. If you accept that thesis, then you would think it's difficult for them, either of them, to build the rationale for making the trade-offs to reopen government. If you look at it from the Republican standpoint, if Democrats feel that they lose while shutting down the government, then you're going to extend that pain as long as you can. And as Eric pointed out, that's usually the next military payday. So Democrats, by positioning themselves even to be blamed for shutting government, know that in 2 weeks you have to open it. Well, if that's the case, maybe you take the 7-week deal and you talk about health care every day and you make your very good points that resonate with voters, but not in a shut government.
All right, Kim, got to leave it there. Kim Wallace, head of Washington Policy Research at 22V. We'll be back in a moment. This is Bloomberg.
All right, it's time now for the top 3, where we name drop the people driving some of the day's most talked about stories. And first up, Dimensional Fund Advisors co-CEO Gerard O'Reilly, the SEC intending to grant the firm the ability to offer ETFs as share classes of mutual funds. I spoke with Gerard earlier today.
What you can expect from Dimensional is that in the near future, we expect to file amendments to the registration statements for a number of existing mutual funds. And what we hope to be able to accomplish then is early in the new year, so in the first quarter of next year, have ETF share classes available in the marketplace. So that's what our expectation is. We've been ready to go. We've been waiting and working with the SEC.
The head of Dimensional there. Another person that I'm keeping an eye on is Charlie Javits. Of course, this was the entrepreneur who sold her student finance startup to JP Morgan for $175 million and then was accused of fraud. In fact, she was convicted of fraud, and now we're learning that she's been sentenced to 85 months behind bars.
Just an amazing story to keep track of start to finish. Let's also talk about Bad Bunny, the musician slated to headline the 2026 Super Bowl halftime show in Santa Clara, California. This is interesting because it's the Super Bowl, but also because he doesn't have any U.S. dates on his actual tour.
Yeah, I mean, he's just coming off this residency that he had in Puerto Rico, which I should remind you is actually in the United States, Katie Gradfield.
Thank you.
But yes, he has been touring primarily overseas. But yeah, I mean, this is a big win. I mean, there was a lot of speculation as to who would do the Super Bowl.
Taylor Swift.
Taylor Swift. She did not get it, I'm told.
No.
She seemed like she would have been likely, given that she's always at these games anyway, right?
I feel like she would write her first refusal.
Is she just too big for the Super Bowl? Is
she
that the
might
idea?
be,
Okay.
Maybe she doesn't want to take away from her wedding. Who knows?
All right. Well, Bad Bunny ain't too big. In fact, we should point out Bad Bunny has had a huge impact on the economy down there in Puerto Rico. And in fact, we're going to talk a little bit later about so-called Latino GDP, basically the contribution of Hispanics to the bottom line here in America. That conversation with Trujillo a little bit later. All right, time for a look back in history, way back in history, to 1916. That's when a front-page story in the New York Times declared John D. Rockefeller as the world's first billionaire. Now, while historians quibble as to whether the Times jumped the gun a bit on that declaration, Rockefeller's wealth was by any measure unimaginable for the time. Before 1900, there wasn't even a consistent Anglophone definition of the word billionaire. And in 1916, the second richest person at the time, Henry Clay Frick, his net worth, it was barely a quarter of Rockefeller's. Andrew Carnegie, Henry Ford, Vincent Astor, their net worths barely a tenth. In fact, almost 50 years later, in the late 1960s, there were still fewer than 10 billionaires worldwide. And in 1982, when Forbes started publishing its list of the 400 richest Americans, there were still only 13 billionaires named. But the computer age of the 1980s and the internet boom of the 90s would open the floodgates for a new breed of ultra-wealthy that vaulted billionaires from a rare curiosity to their own identifiable class. That was when wealth, which for decades had largely been determined by existing physical assets like property and machinery, shifted to more esoteric drivers like intellectual property and the future value of invention. The barometers of wealth moved off the balance sheet and into financial markets. It was in the 1990s that the number of billionaires globally surpassed 100, and by 2008, surpassed 1,000. Today, in 2025, there are more than 3,000 confirmed billionaires, more than 6 times the number at the start of the current century. In fact, billionaire status, at least as a 10-figure number, that's almost passé. Now, in this new Gilded Age, it's all about 12 figures, the centibillionaire. Microsoft co-founder Bill Gates became the first person ever to cross the $100 billion threshold all the way back in 1999. Amazon's Jeff Bezos hit that milestone in 2017, and as of today, the Bloomberg Billionaires Index shows 17 people with 12-figure net worths. That includes Carlos Slim, Alice Walton, Jensen Huang, and now Larry Ellison. A number that, if history is any guide, is almost certain to continue growing. Katie?
Well, to keep it going, quantum computing could be the next billion-dollar bet, maybe a cent-a-billion-dollar bet, with a recent leap forward coming out of IBM and Vanguard. The company saying that their recent exploration into how quantum technology can reshape portfolios is yielding promising results. Now, that partnership focused on optimizing a municipal bond portfolio using IBM's most advanced quantum processor, IBM Quantum Heron, to enhance a classic computing workflow. Joining us now exclusively, I'm pleased to say, are Paul Malloy. He is head of municipals over at Vanguard, as well as Scott Crowder, VP of Quantum Adoption for IBM. Great to have you both with us.
For being here.
So I'll start with you, Scott, because IBM and Vanguard, typically people don't think of those two companies in partnership with each other. So just talk to us a little bit about how this came to be.
Well, we're always looking for leading innovators in industry who want to explore how to use quantum computing as a tool for their industries. Because we put a lot of work into building better and better hardware and software as we advance it. But we know equally important is building better and better algorithms and understanding how those algorithms can be applied to real-world problems. So we were very lucky to be able to partner with Vanguard on this project.
And let's talk about what exactly this yielded, because I believe it was a municipal bond portfolio, right, that contained 109 securities. So when we say it was optimized, what does that truly mean here?
Yeah, so what that really truly means is we were able to take something that we do very well today. We optimize portfolios at much larger scale and reframe that problem and put it into quantum space. and we're able to actually get the same result out of a 109 bond portfolio. We came into this thinking we'd maybe get 30 to be able to get somewhere close using the quantum technology, but it was a really promising experiment for us to be able to get up to 109 bonds and have it match current level results.
So for those folks who aren't familiar with how this technology, just give us a sense here. We're talking about speed, but it's a little bit more than that, right? I mean, it is about the sequencing of potential returns, potential scenarios in a way that you couldn't do before. What's different?
Yeah, so what's different about this particular case is it allows us to put a lot of different scenarios up and run in parallel. You're typically running a lot of simulations and scenarios in order. And it really limits you to how much you can put together. And when we put this through a quantum machine and find the right quantum algorithm, we can start to let correlations pop up that we maybe did not know were there before. So it's not just about speed, it's about speed to insight. And at the heart of quantum computing is probabilities.
So Scott, I mean, how did we get here? And when we talk about the technology behind this, I mean, it's been lingering around for a while.
Right.
Why is it now sort of becoming a thing? And the second part of that question, is it cost effective enough for companies to really start to deploy it?
Sure. I think why it's taking off now is because we now have computers, quantum computers that can run programs that you can't simulate classically. So it allows us to use it as a tool to explore spaces that you can't simulate. This work basically showed that this approach, by breaking the problem into doing part of it on classical computers and part of it on quantum computers, worked. And it showed the kind of results that we were expecting, and we could scale it. So today it's not better than the classical optimization approach, but if it continues to scale, it'll be able to solve problems that you can't solve using the classical approaches today. In terms of cost effectiveness, we have more learning to do. We have more learning as it scales to understand, does it scale well? Are there more algorithmic innovations that we can do that even get it better than where we are today? And that's what we hope to be working on with Vanguard going forward.
Is there a timeline that you can put on that? You talk about how there's more learning to do when we talk about scaling before you see some of those cost efficiencies. Can you put numbers to that, or is it just too early?
So we can put numbers to where we are going to be on the hardware and software roadmap. So we basically have stated that by next year, we will have the first examples of what we call quantum advantage, where running it on a quantum computer gives you a better outcome than any other classical approximate method for the first use cases. Not for everything, but just for a couple. And then by 2029, building much larger computers that can run much more complex programs. It's called large-scale fault-tolerant quantum computers by 2029. What we don't know is we don't know when the exact date is going to be that leveraging these algorithmic approaches are going to show significant advantage over classical. And that's why we do the work with partners like Vanguard.
Well, Scott mentioned use cases, and Paul, I want to talk about where this could go. As I mentioned, you started with a portfolio of municipal bonds. Muni bonds aren't exactly the most exciting asset class in the world, not to offend anyone. Where else could you see some of these quantum processes being applied?
Yeah, this is really just the beginning. So, so we started with municipal bonds because we had such a strong benchmark to go against. It gave us confidence that we were really putting quantum up against something we felt was world-class already. Once this can scale, you can start to bring in so many other factors. This could be across multi-asset, taxable. You could do more combined portfolios, stocks, bonds. The sky's the limit, and the technology is the limit. So it's got quite a bit of learning curve associated with it. So we have to start thinking now. It really is a different way of thinking and framing the problem, and that's why we're so excited about it, that we can rethink the problem and have the technology to try it out.
So it gets to this idea. I mean, are we going to start applying this soon, do you think, in your view, to the other asset classes? And is it going to be sort of, I guess, broader than just a behemoth like Vanguard, which, of course, has the resources and the people and the know-how to do it, maybe down to, say, a boutique or a hedge fund to be able to also use this as well?
Yeah, I mean, I think over time, things do become available to the masses, but at the same time, there's a steep learning curve associated with even just formulating the problem space. It took us nearly 2 years to formulate the problem space that we are now. So I don't think it's a turnkey operation to be realizing that value out of the gate.
All right, guys, great stuff. And this is a huge milestone, we should point out. And we talk about the advancements in quantum. Love to have both of you back on to gauge that progress as it goes forward. Paul Malloy there, head of municipals at Vanguard, and Scott Crowder, VP of quantum adoption for IBM. We need to go back down to Washington. Congressional leaders began a meeting at the top of the hour with the President of the United States on that budget impasse. That meeting is over. Democratic leader Chuck Schumer speaking at the microphone alongside Hakeem Jeffries. Let's listen in.
They never talked to us. Thune didn't negotiate with me. Johnson didn't negotiate with Hakeem. And on the key issues, the Appropriations Committee, which has talked about 3 of the smaller bills, they're good bills, they said the appropriators couldn't agree and said kick it up to the 4 leaders. They still haven't talked.
And let me say, we're deadly serious about addressing the Republican-caused health care crisis because it's a deadly serious issue for the American people. Largest cut to Medicaid in American history. Hospitals, nursing homes, and community-based health clinics closing right now. The fact that more than 20 million Americans are on the brink of experiencing dramatically increased premiums, copays, and deductibles because of the Republican refusal to extend the Affordable Care Act tax credits, which benefit working-class Americans. And we pointed that out. I pointed that out. Working-class Americans. Their health care, that's what we're fighting to preserve, to defend, and to strengthen.
Thank you.
Question?
Yeah, we're going to take questions or not? No. Yeah.
Okay, thank you, everybody.
Was there any mention of a shorter CR? Is the government going to shut down in 30 hours?
And right now, you're taking a look at the Democratic leaders of the House and the Senate, Chuck Schumer and Hakeem Jeffries, walking away from the White House after a relatively brief meeting with the President of the United States and the 2 Republican leaders in the House and Senate, trying to reach an impasse over that budget bill, a bill that the Republicans are unified on, but the Democrats have to make some hard decisions about whether they will support it. If they don't support it, the government, Katie Greifeld, would shut down at midnight on September 30th into October 1st.
Yeah, brief meeting, like you said, though we did hear from Chuck Schumer saying that I think for the first time, President Trump heard our objections, but also noting that in the meeting with Trump, we have large differences. We'll continue to follow that story. But let's take a look at some movers in after hours trading. Earnings season never ends. We got some reports after the bell from the likes of Vail and Jeffries. You can see that Vail falling about 3.4%. They came in light across most metrics. Jeffries, this is an interesting one, actually posting record revenue with deal making, staging a comeback here. But similar to Carnival, you can see a tepid response from the market. Jeffrey shares down about 1.4% in after hours trade. And how about Firefly? I know you were excited about this one, Romain.
Yeah, I mean, this just started moving here in the after hours trade after we're learning that apparently yet another rocket was lost. This was a testing stage. And of course, a Firefly, one of these companies that sort of aims to be, if you will, I guess, a competitor to SpaceX, which has had a huge head start in this space. And we should point out, though, too, in fairness to Firefly, you know, SpaceX lost quite a few rockets on its way to dominating this space. But again, something to keep an eye on. Those shares now down about 10%. We need to go back down to Washington right now, where the Vice President of the United States, J.D. Vance, is speaking at the microphone. Let's take a listen.
For shutting down the people's government and all the essential services that come along with it. If you look at what Chuck Schumer has said in the past consistently, it's whatever our disagreements are, let's negotiate with them. Let's talk about them. Let's figure out a bipartisan solution, but you don't shut the government down. In other words, you don't put a gun to the American people's head and say, unless you do exactly what Senate and House Democrats want you to do, we're going to shut down your government. That's exactly what they're proposing out there. Now, we have to remember, they're very frustrated. They say that they're very frustrated about the fact that this negotiation has not taken place until today. But if you look at the original thing they did with this negotiation, it was a $1.5 trillion spending package, basically saying to the American people, we want to give massive amounts of money, hundreds of billions of dollars to illegal aliens for their health care while Americans are struggling to pay their health care bills. That was their initial foray into this negotiation. We thought it was absurd. We told them it was absurd. And now they come in here saying that if you don't give us everything that we want, we're going to shut down the government. We think that's preposterous. We think it's totally unacceptable, and we think the American people are going to suffer because these guys won't do the right thing. Now, I want to make one final point here. You will hear a lot from Senate Democrats, from House Democrats about the fact that American health care policy is broken. Well, we know that American healthcare policy is broken. We've been trying to fix it for the 8 months that we've been in office. But every single thing that they accuse about being broken about American healthcare is policy the Democrats have supported for the past decade. So if they want to talk about how to fix American healthcare policy, let's do it. The Speaker would love to do it. The Senate Majority Leader would love to do it. Let's work on it together. But let's do it in the context of an open government that's providing essential services to the American people. That's all that we're proposing to do. And the fact that they refuse to do that shows how unreasonable their position is. I think we're headed to a shutdown because the Democrats won't do the right thing. I hope they change their mind, but we're going to see. I'll let the Speaker say a few words.
Thank you, Vice President Vance. I want to thank the President as well. They showed strong leadership today. They invited the 4 leaders over here because the President is operating in good faith, and he demonstrated that very well. The problem is that Chuck Schumer and Leader Jeffries refuse to acknowledge the simple facts. Let's review what the simple facts are. As the Vice President was saying, this is the common sense thing to do. This is the right thing to do. This is the simple thing to do. By way of review, the House is getting back to the way the regular appropriations process is supposed to work. 12 separate appropriations bills passed through the House Appropriations Committee, 3 off the floor. The Senate doing their work as well. All this in bipartisan fashion, by the way. They passed 3 bills in the Senate. Those bills don't match up exactly. So for the first time in years, since 2019, you have a conference committee that is being constituted between the House and the Senate. This is the way a bill becomes a law. They work out the differences. All this is happening in bipartisan fashion. The problem is we've run out of clock. September 30th is the end of the fiscal year, so we need a little more time. So what we did in the Republican majority is the right, responsible, simple thing. A clean, continuing resolution, a short-term, nonpartisan continuing resolution. It's only 24 pages in length. Leader Thune has a copy if you want to see the exhibit. There's nothing partisan in here. No policy writers, none of our big party preferences, because we want to do the right thing by the American people and allow more time for negotiation. Now, there's a reason that Chuck Schumer and Hakeem Jeffries have come out here, stomped the feet, saying that they can't go along with this. They're trying to bring in extraneous issues. They issued a counterproposal. You should go take a look at what they requested. $1.5 trillion in new spending that is unrelated to the ongoing appropriations process. They wanted to, as you said, restore taxpayer-funded benefits, okay? Hard-working taxpayers in America. They want to take your funds and give that for benefits to illegal aliens. They want to restore that because we got rid of it. They want to prop up left-leaning media outlets. $500 million they threw in on top of that. $1.5 trillion on a 7-week stopgap funding measure. We're not going to do that. They know we can't do that. And we never have in the past. During the Biden administration, there were 13 threatened shutdowns. The Republicans in the minority did the right thing. We kept the government open. We're simply asking for the Democrats to do the same. Again, I want to thank President Trump for the strong, solid leadership. He listened to the arguments, and they just wouldn't acknowledge the simple facts. I want to thank Vice President here for showing his leadership as well. If the Democrats make the decision to shut the government down, the consequences are on them, and I think it's absolutely tragic. We've never said that was a good idea. We never believed it is. And I want you to remember, when we voted in the House, we passed it out of the House. The House has done its job. We did that almost 2 weeks ago. Every Democrat in the House, except one, voted to shut the government down. That is the record. And don't forget it. I'll ask Leader Thune to step in here.
Well, thanks for speaking, Mr. Vice President. This right here, ladies and gentlemen, is what we're talking about. 24 pages. It's a continuing resolution to fund the government.
All right, you were listening to Vice President J.D. Vance speaking alongside House Speaker Mike Johnson, of course, as we count down to that potential shutdown of the government. You heard the Vice President describing the meeting with the Democrats as frank, but saying that I think we're headed to a government shutdown, that the Democrats threatened a shutdown if their demands were not granted. You also heard House Speaker Mike Johnson saying that the president is operating in good faith in these shutdown talks. But Romaine, we know that there is a wide gulf between these two sides, and certainly not a lot of time left.
Yeah, just basically less than 48 hours if you want to be specific about it. And it gets to a lot of questions about what the potential economic impact could be. But quite frankly, we got here because of a lot of the issues with regards to how to steer this economy from a fiscal perspective. And of course, with a lot of other policies coming out of Washington, it has put plainly in focus the complexion of our society and a lot of questions about who contributes to that. We want to pivot and talk a little bit about some of those contributions, particularly when it comes to Latino immigrants. Here in the U.S., They accounted for $1.6 trillion in GDP in 2023. This is according to a new study out of the Latino Donor Collaborative. It's a substantial chunk of the overall $4.1 trillion in purchasing power that U.S. Latinos wielded last year, which is larger than the GDPs of India, the United Kingdom, and France, among others. We want to bring into this conversation the co-founder of the Latino Donor Collaborative, Sol Trujillo. He's founder of the Velocity Conference and chairman of the Trujillo Group. Great to have you here on the program.
Thank you for having me.
I think anyone who has followed our economy over the last few decades understands just how much Latino immigrants and the Latino population have contributed to that growth. As you know, we are in a time frame right now where a huge chunk of that community has been under pressure, whether it's through the immigration crackdown or other political issues that have sought to, I guess, rethink what their role in this society is. When I look at a number about what they're contributing, I'm having a hard time squaring that with some of the political rhetoric that we're seeing that seems to be antithetical to that contribution.
Well, I think it's antithetical to the contribution, but it just doesn't make sense if you're a capitalist. Now, I sit here today talking to you. I am a capitalist. I've been a capitalist my whole life. Mm-hmm. So I love this country. I love the rule of law. I love the Constitution. I love all the economic foundaries that we have in our country. So we started doing the study several years ago because of people's misinterpretation of immigrants. Mm-hmm. Well, I would say the president is like a second-generation German immigrant, mm-hmm. right? So, and plenty of the other people that are in his cabinet. Mm-hmm. So we're all mostly immigrants. The Native Americans are the only originals. So we think that data matters. As a CEO of large companies around the world, I always thought data mattered, mm-hmm. as opposed to opinions. Mm-hmm. So we went out and gathered the data. The data shows just what you saw and what you read about the 1.6 trillion of these immigrants. But let's remember that 95% of those that are 18 or younger that have a Latino last name mm-hmm. are native born. Mm-hmm. 85% are here legally and with documents and all that, mm-hmm. in spite of ICE and whatever they might be supposing that they're doing. So this is a business conversation. The event Velocity was about presenting data that says, number one, this cohort is the only sure bet in our economy for the rest of this decade, because it's going to continue to grow.
Before we go deeper into that data, I am curious if you've seen material evidence of a slowdown in economic activity in our Latino communities. It's one thing to say that these immigration raids on undocumented immigrants, I understand that has an impact. But for those people who are either born here or are here legally, are they also maybe pulling back, retrenching a bit?
Well, I would say a simple yes to your question, but it's not the full answer yet. The whole economy, if you look at the bottom 90% of our economy, their purchase behavior is now slowing. You see it in the sales results of Target and Walmart and even Amazon and those who are digitally founded. So it's happening everywhere. If you look at the retail sales announcements a couple of weeks ago, 90% of the growth in retail sales was tied to price ups as opposed to volumes. So yes, the volumes are down with this cohort, but the upper 10% now is accounting for about 50% of the sales volume increases. Think about that. We've never had that in the history of this country. So we're concentrated. Right now, our population under OECD rankings, we are more concentrated in wealth than Saudi Arabia. So, and you know, anybody can check that. So I'm not here with an opinion. I care about our economy. I want an economy that works for all people. So I like to bring data, and in particular, this cohort is one of the engines of growth. And the last thing I'll say is that what sets the United States of America apart from Europe that slowed down, from Japan that slowed down, from Russia that slowed down, and now China, is that we have a growth cohort in our corpus.
Right.
And it's young.
Yeah, well, let's talk about that a little bit more, the data that you're bringing to the show. You talk about that growth cohort, the fact that this is a young population, too, that we're talking about. Where is growth accelerating? We talk about this overall spending slowdown that you're seeing economy-wide, but what categories are most resilient when it comes to U.S. Latinos specifically?
Well, I'll say two or three things very quickly. One is geographically. 48 of the 50 states are now tied. They're dependent on this cohort for growth, for entrepreneurship, starting businesses, et cetera, et cetera. The second thing that I'd say is that manufacturing. This cohort is now representing one of the biggest growth rates in terms of manufacturing. So whether you're Biden or Trump, you talk about reshoring. Well, who's going to reshore? Who's going to manufacture it? All that sort of thing.
Right.
Well, the Latinos are growing double-digit rates, strong double-digit rates in terms of manufacturing, and also in terms of business startups, business formations. They're growing at more than 2 times the rate of the rest of the economy. So it's about the basic. What's the DNA of the United States? Entrepreneurship,
right.
Investment, and making your way going forward. So, I mean, it's like the ideal cohort that you want to have. And so now my point is investment.
Well, let's talk a little bit more about geography. I thought it was interesting that the report highlights California, Texas, and Florida as the top state contributions. So you talk about investment. Is that more on the part of governments in those states, or are you talking about private businesses?
Well, I think, again, this is another great question. Businesses that are investors, the investor class. I had Bain Consulting do a study 2.5 years ago, 3 years ago, that showed that less than 1% of invested capital is going into this cohort that's accounting for $4 trillion of GDP, that's accounting for 80% of all the net new workers, and about 80% of all net new businesses. So as a capitalist, I'm looking at it and saying, let's go get the data and let's share the data, which you're doing today, which I really appreciate, because as an American, I want to see us grow. I want to see us differentiate. So geography is a big deal. Those states you mentioned, just to finish off, they are getting a disproportionate benefit of this cohort. When you look at the GDP percentage of GDP growth, it's tied to them as cohorts: Texas, Florida, California. But there's many others.
Are you trying to get this message across to folks in Washington right now? And if so, what's been the response?
Well, right now, Washington has been tied up in extraneous issues like deportations, which I think don't make a lot of business sense. So when you think about the other issues of growth and investment, I think the business community has a role here. The Business Roundtable, all the business entities, they have to understand their growth is here. And I can tell you, we've also done studies to show the percentage of their growth tied to this cohort in many cases, maybe more than 50%.
So we have to get you back. This is a great conversation. We're up against a commercial break, but it's wonderful to have you and some great data coming out of the folks over at Velocity. Sol Trujillo is the co-founder of the Latino Donor Collaborative. This is The Close on Bloomberg, but stick around. Balance of Power is up next. They're going to have an update on that budget fight in Washington.